Assalamualaikum, everyone. We know by now that the Quran has prescribed al-bay' over riba. And we can see, for example, in Surah Al-Imran, ayat 130, the Quran says, Ya ayyuhalladhina amanu la ta'kulu riba ad'afan mudha'afa. Oh, you believe, do not consume riba that double and quadruple. So that is essentially a commandment to stay away from riba. But then in Surah Al-Baqarah, ayah 275, the Quran says, وَآهَلَ اللَّهُ الْبَيْءَ وَحَرَمُ riba, that Allah has permitted al-bay' but prohibits riba. So here in the later surah, we see that the Quran has prescribed an alternative to riba, that is al-bay'. So al-bay' is the alternative to riba. So in a sense, the riba is prohibited, while al-bay' is permissible. And when we look at the comparison between the two rule, or the two hukum, or two ruling, something that is prohibited is evil, it is unjust, it is not desirable to Islam, whereas that which is permitted are those that are good and with justice, with equity, and thus we need to see to what extent al-bay' is able to amplify the goodness and the morality of doing business, and to what extent is riba evil, in the sense that when riba is transacted, it will generate an unjust system. So this is a very important junction where we need to see where can we apply the al-bay' over riba. And of course, the logical place would be the commercial banking business. It will not be the unit trust business or the mutual fund business, because these business are based on equity investment, where people put money into the unit trust fund. And this unit trust fund or mutual funds, these are essentially equity funds. They are not money lending funds with riba. Also, if we look at fund management business, this is asset management. We are dealing with managing asset that can be either debt or equity. And so the riba element is not overwhelming in the asset management or the unit trust business. Likewise, in the venture capital business, most of which the instruments are driven by equity. So the only logical place for us to look into is the commercial banking system, where, as we know, that the basic character of the banking business is to take interest-bearing deposits and using this interest-bearing deposit to make interest-bearing loans. So, for example, if we have a 100 billion deposit at 2% per annum, and this deposit fund is used to make loan at 7% per annum, then we can see that this 100 billion worth of loan at 7% interest charge, will generate an interest revenue of 7 billion, while the cost of deposit will be 2% multiplied by 100 billion, that would be 2 billion. So the gross earning from the banking business would be 7 billion minus 2 billion, and that would be 5 billion. But the business is not that easy, because to assume that the bank is able to acquire this 5 billion interest revenue, it assumes that all of the loan the bank is making are good loans or prudent loans, loans that have less possibility of default. So whatever loan that the bank gave away will generate a revenue based on the 7% loan rate. Yeah, likewise, so if the bank is not careful and making a subprime loan or bad loan where the possibility of default would be much wider, then the default will of course reduce collection of the revenues, and the bank will have to make a big provision for the impending losses, and this will affect the gross earning. Likewise, if the bank is not careful, when the bank make a loan, and if the loan rate is not adjustable, so any increase in the interest rate, as dictated by the central bank, will increase the cost of fund, and that will increase the cost of deposit, and that will eventually reduce the gross earning. So both credit risk and market risk will have an impact on the banking revenues and the banking interest expense, leading to whether or not the bank is going to make profit or losses. But the main idea here for us to contemplate is that what matters to the bank is that this earning, any earning that is generated from the taking of deposit and the making of loan with interest, must have a positive impact on their capital, right? So we know that bank must hold minimum capital, or there is a paid up capital required by the regulator for any bank that is establishing the banking entity. So meaning that the minimum paid up capital for any commercial bank is, let's say, 10 billion ringgit or dollar, for example. So that would be the paid up capital. So the shareholder have to come up with 10 billion worth of capital to initiate the business of mobilizing deposit funds, interest-bearing deposit fund, that the bank would use to make interest-bearing loans. So this particular modality is not like the traditional or Jahiliya modality where the lending party will use his own capital to make the riba loan, right? We're not looking at a situation where, let's say, Abu Sufyan, in Mecca, he will use his own dinar to make loans, to make this riba al-jahiliyyah. He will not borrow from Abu Jahal or other merchant in order to make a loan to the respective borrower. Yeah. So, but in the modern banking system, we will see that the owner of the bank, that is the shareholder, they will be the one who will be investing in the bank, and any losses from the loan business or the deposit business will have an impact on their investment, which is their paid up capital. So if the bank is not careful when they are making a loan, they are making a loan to their family members, to their business partner, where there is not enough scrutiny undertaken to assess the loan, and at the end of the day, there is no robust so-called system that is used to assess the loan, and at the end of the day, the bank end up making loans to the wrong people, that is people who are not deserving, and eventually they will default on the loan, and who will be absorbing the losses? Of course, the shareholder will be absorbing the losses. So if the loss is 2 billion and the loan provision is only 1 billion, so the residual loss or the extra loss of 1 billion will have to be absorbed by banking capital, right? So the banking capital was at 10 billion. Now with a loss of 1 billion after loan provision, then the capital fund will contract from 10 billion to 9 billion. And this is what the banking business want to stay away from. So in order for them to make a positive earning that can lead to capital expansion rather than capital depreciation, then the bank must be able to ensure that every loan that they make must be a prudent loan. It must be a good loan so that they can maximize on the revenue collection and eventually enjoying the earning. And that earning will translate into capital expansion. So it is not simply in Islamic banking, for example, swapping the system from riba-based to Islamic-based by swapping Shariah compliant product, from the interest-bearing product. That's not enough or sufficient to guarantee that the bank is able to make money from this business of deposit taking and loan making. Sharia compliant is only a system to verify that the product are removed from the element of riba, element of gharar, element of maisir, element of pork and alcohol in the transaction. It is a screening methodology that the Islamic bank must observe to ensure that the contract are free from this prohibition. But then when it comes to the making of the tawarruk or the issuance of tawarruk, the making of murabaha, the process of assessment, evaluation, the rule to which the customer is to be screened using the 5C of credit or the FICO system. This must be fully observed by the Islamic bank to ensure that that the bank is actually giving the murabaha financing to the right customer who are able to pay back what they owe the bank. So the debt obligation from tawarruk or from murabaha or from babi thaman ajil, must be dutifully fulfilled by the customer to ensure that the bank is able to generate a positive earning. So Sharia compliant does not only imply screening the product from the prohibition, but it is also to ensure that the bank have a robust, system to assess the so-called the quality of the facility to be awarded to the prospective customer. And this is a very important area that has been overlooked, in Islamic banking, because focus on Sharia compliance have pulled us away from the importance, from giving importance to lawful earning and how that earning will be able to impact capital, because capital is the most important element in banking, because the chairman of the board will always mention in his annual report that the ROE or the return on equity is this much, that much, and it is above the targeted rate. And this is how the Islamic banking must also be able to mirror image this performance aspect of the Islamic banking, other than focusing on the Sharia compliant perspective. This area of financial performance must be given equal attention in the Islamic banking business, as well as in the education of Islamic finance in the universities. Thank you very much. I'll see you again. Assalamualaikum warahmatullahi wabarakatuh.